Most people hear the word budget and immediately think of restriction. They picture a spreadsheet full of limits, a list of things they cannot buy, and a general sense of deprivation. That association is one of the main reasons most people never build a budget that actually works. A budget is not a punishment. It is not a document that tells you what you cannot have. It is a plan. It is a written record of where your money is going so that you are making deliberate decisions about it rather than looking at your bank account at the end of the month and wondering where everything went. This lesson is going to explain what a budget actually is, why it matters, and how to build one that reflects your real life. The core purpose of a budget is to give you visibility and control. Visibility means you know exactly how much money is coming in and exactly how much is going out and where it is going. Control means that you're deciding in advance how your money gets allocated rather than finding out after the fact. Most people who feel like they never have enough money are not necessarily earning too little. They simply have no system for tracking where their money goes, and without that system, money tends to disappear into a pattern of small, unconsidered spending that adds up to a large number by the end of the month. The first step in building a budget is calculating your income. This means your net income, not your gross income. As we covered in the previous lesson, your net income is the amount that actually gets deposited into your bank account after all taxes and deductions have been taken out. If you're paid bi-weekly, you receive 26 paychecks per year. To calculate your monthly net income, multiply your net pay per paycheck by 26 and then divide by 12. If your net pay is $1,200 per paycheck, your annual net income is $31,200, and your average monthly net income is $2,600. That number is your starting point. Everything in your budget works backward from that figure. If your income varies from month to month because you're self-employed, work hourly with fluctuating hours, or earn tips or commissions, calculating your income is slightly more complicated. In that case, look at your income over the past 3 to 6 months and calculate the average monthly amount. Use a conservative estimate, meaning use a number that is on the lower end of what you typically earn rather than the highest month. Building your budget around a conservative income estimate means you are prepared for slower months and pleasantly surprised during stronger ones, rather than the other way around. The second step is listing your expenses. This is where most people underestimate how much they are actually spending. There are two types of expenses: fixed expenses and variable expenses. Fixed expenses are the same amount every month. Rent, car payment, insurance premiums, loan payments, and any subscriptions with a set monthly cost are all fixed expenses. These are the easiest to account for because the number does not change. Variable expenses are the ones that fluctuate from month to month. Groceries, gas, dining out, clothing, entertainment, and personal care all fall into this category. Variable expenses are harder to budget for because they require you to look at your actual spending history rather than a fixed number. To get an accurate picture of your variable expenses, go back through your bank and credit card statement from the past 2 to 3 months and categorize every transaction. How much did you spend on groceries each month? How much on gas? How much on restaurants and takeout? How much on subscriptions, streaming services, and apps? How much on clothing? How much on things that do not fit neatly into any category? This exercise is often uncomfortable because the numbers are higher than people expect. The point is not to feel bad about the spending. The point is to see it clearly so you can make intentional decisions about it. Once you have your income and your expenses laid out, the next step is the most important one: comparing the two. Your total expenses should be less than your total income. If they are, you have money left over each month that can go towards savings, investments, or paying down debt. If your expenses equal your income, you are breaking even, which means any unexpected expense will put you in the negative. If your expenses exceed your income, you're spending more than you earn, which is a situation that cannot continue indefinitely and needs to be addressed directly. When expenses exceed income, there are only 2 ways to fix it: increase income or reduce expenses. Increasing income might mean asking for a raise, picking up additional hours, taking on a side job, or developing a skill that leads to better paying work. Reducing expenses means looking at your spending and identifying where cuts are possible. Not every expense can be reduced. Rent and loan payments are typically fixed. But most people find, when they look honestly at their variable spending, that there are areas where they're spending more than they realized and more than they actually need to. The goal is not to eliminate enjoyment from your life. The goal is to make sure your spending reflects your actual priorities rather than just your habits. A budget should cover every category of spending in your life. Most people find it helpful to organize expenses into broad categories, such as housing, which includes rent or mortgage, utilities, and renters or homeowners insurance. Transportation, which include a car payment, gas, insurance, parking, and public transit. Food, which should be broken into groceries and dining out separately because they behave very differently, and the dining out category is one of the most common places where spending is higher than expected. Personal care, which includes haircuts, toiletries, and similar expenses. Health, which includes any out-of-pocket medical costs, prescriptions, and copays. Entertainment and subscriptions. Clothing, savings and investments, and debt payments listed individually so you know exactly what you owe and to whom each month. One of the most common mistakes people make when building a budget is forgetting irregular expenses. These are expenses that do not occur every month, but are entirely predictable. Car registration, annual subscriptions, holiday gifts, back-to-school costs, and seasonal expenses like holiday travel are all examples. Because they do not show up every month, they're easy to leave out of a monthly budget, and then when they arrive, they feel like surprises that throw everything off. The solution is to take your known annual irregular expenses, add them up, divide by 12, and set aside that amount each month into a dedicated savings account or budget category. When the expense arrives, the money is already there. The final piece of a working budget is the habit of reviewing it regularly. A budget is not something you build once and then forget. It is a living document that needs to be checked against your actual spending at least once a month. Most people find it useful to do a monthly budget review on the first or last day of the month, where they compare what they plan to spend in each category against what they actually spent. Categories where you consistently overspend are telling you something important, either that the budget for that category is unrealistic and needs to be adjusted, or that the spending in that category needs to change. Either way, the review gives you the information to make that call. There are many tools available for budgeting. A simple spreadsheet works well for people who are comfortable with numbers and want full control over how their budget is organized. Budgeting apps like INAB, which stand for You Need a Budget, or Mint, or Every Dollar, connect to your bank accounts and automatically categorize your transactions, which reduces the manual work significantly. Some people prefer a notebook and pen. The tool matters less than the consistency. Whatever format you will actually use regularly is the right choice for you. A budget is the single most foundational habit in personal finance. Everything else in this course, building savings, managing debt, investing, planning for retirement, all of it becomes easier and more effective when you have a clear, accurate picture of your income and expenses. You cannot manage what you cannot see. A budget gives you that visibility, and with visibility comes the ability to make real, informed decisions about your money rather than just reacting to whatever is happening in your bank account at any given moment.